Welcome back to the Deep Dive. Today, we are really digging into something specific for you, commercial real estate in Texas.
Yeah, and we've got a great source. It's a curated list, investment opportunities, market commentary. It's all from Eureka Business Group, EBG.
Dated October 25th, 2025. And it's laser-focused, isn't it? Just Dallas-Fort Worth, DFW.
Exactly. It gives us a really sharp lens on what investors are thinking right now. Our mission today, basically, is to figure out EBG's take on the market.
Right. What do they think? And what makes a property high value in their eyes?
And also, what kinds of investments are actually moving? Retail, industrial, land, across different price points in DFW. What's active?
Okay, let's jump right in, because the first thing they mention, this market commentary,
Yeah.
it sets a bit of a skeptical tone, wouldn't you say?
It does. They talk about noticing a slight compression in cap rates.
Which normally you'd think, okay, prices are going up, market's getting tighter. Good news, maybe?
Usually, yeah. But EBG puts the brakes on that thought pretty quickly.
Oh, so what's their interpretation?
Yeah. Well, what's really interesting is they don't see this as some fundamental sign of, a stronger economy or a big market upswing.
Okay.
Their take, it's sellers. Sellers hearing all this talk about interest rates maybe coming down, and they're trying to basically claim that future value now.
Ah, so they're pushing asking prices up based on optimism.
Pretty much. Which, artificially pushes down the cap rate on paper.
So it's not really reflecting better cash flow or lower risk. It's more like wishful thinking in the price tag.
Exactly right. And that
Right.
difference is, well, it's crucial for how they invest. EBG is really clear. The seller optimism, it doesn't impact our opinion of values.
So they're telling investors, hold on, don't chase those low cap rates.
Precisely. Their data, what they're seeing close, shows good quality properties are still trading, firmly in the 7% to 8% cap rate range. That's their anchor.
That's a clear line in the sand. But, why should we trust their skepticism over what seems like general market movement? What if an investor just ignores that 7-8% anchor?
Well, if you ignore that, you're essentially paying a price based on hope, right?
Yeah.
You're taking on the seller's gamble that the market's going to suddenly jump up to justify that squeezed rate.
Risky.
Very. EBG says they base offers on good value for our investors and clients, not based on what the seller's asking price is. It's about security, proven cash flow, not speculation. That's really what sets their approach apart, I think.
Okay, that makes sense. That foundation leads us right to the properties they do recommend. When they list these top opportunities, what are the common threads? What's the anatomy of a good deal for EBG?
Number one, without a doubt, is minimizing risk through the lease structure. You see this overwhelming focus on NN leases.
NNN, just triple net.
Yeah, and specifically the gold standard, absolute NNN.
Okay, let's quickly break that down, because NNN itself is common, but absolute, what does that really add for the investor?
It's basically the highest level of passive income security you can get. When they say absolute NN and pair it with phrases like zero landlord obligations or zero landlord responsibilities,
Yeah.
it means the tenant pays for absolutely everything. Taxes, insurance, all the maintenance, and crucially, the big stuff too. Structural repairs, roof replacement, fixing the parking lot, everything.
Whereas a standard NNN might leave the landlord on the hook for those bigger capital expenses, right?
Exactly. Absolute NNN makes the investment truly hands-off, almost like owning a bond that pays rent.
Okay, so that takes a lot of the operational burden off. Beyond the lease itself, what about the tenant? How important is who is paying the rent?
Oh, it's paramount. You don't really see small independent operators here. Security is key.
So what do you see?
They consistently highlight the need for a corporate guarantee or a corporate credit tenant, or sometimes backing from really established, successful multi-unit franchisees.
Meaning the lease payment isn't just dependent on that one store doing well.
Precisely. It's backed by the larger company's balance sheet, deep pockets. That provides real security if one location struggles.
Got it. And the third leg of this stool seems to be protecting against inflation, yeah?
Absolutely vital. You consistently see annual increases or annual escalations built into these leases.
So the income grows over time.
It has to, especially in a long-term absolute NNN deal. Without those bumps, inflation just eats away at your returns, your actual purchasing power. EBG seems pretty firm on needing this.
Okay, so absolute NNN. Strong corporate tenant, annual rent bumps. Let's make this concrete. Tell us about that first example, the 2,464 square foot single tenant retail place,
Right, that one's like their model starter deal almost. It's listed at a 7.25% cap rate.
which lands right in that 7-8% sweet spot you
Yeah.
talked about.
Exactly, and it ticks all the boxes. Absolute NNN lease, check. Zero landlord obligations, check. It's also got a long history operating since 2008.
Sable.
And critically, a corporate guarantee. So, low risk, predictable yield, solid structure, textbook EBG.
Okay, let's move up the ladder then, into the actual listings they've categorized. Starting with that $2 million to $5 million bracket. This is like a busy category.
It really is. And you see a mix here, retail, some industrial, even land. It kind of reflects a dual strategy happening in DFW.
How so? What's the strategy?
Well, look at the 2,208 square foot single tenant retail listing. Structurally, it's great. 15-year absolute NNN lease annual increases. But the key, location. It's in Anna, Texas.
And they highlight that specifically.
Yeah, they flag Anna as the hashtag for fastest growing city in the U.S. So they're not just buying stable income, they're betting hard on future appreciation driven by explosive growth in that area.
Interesting. Combining stability with a growth kicker, we also see more traditional stabilized assets here, like retail centers.
Right. For immediate reliable income, there's that 9,007 square foot center. It's 100% leased, all NNN leases, and it was just fully renovated in 2024.
So pretty low management turnkey income stream.
Exactly. Or look at the other one, the 5,300 square foot center. What's interesting there is how they specify the tenant quality beyond just the brand name.
What do you mean?
Well, one tenant, Mo Betta's, has a corporate lease backed by the parent company. The other, Donato's Pizza, is backed by a known multi-unit franchisee. EBG's clearly looking past the sign on the door to who's actually guaranteeing that rent check.
Always digging deeper for the real security. Now, there's a more complex structure in this price range too.
Yeah.
An industrial sale leaseback. 9,258 square feet on 4 acres. What's the deal with sale leasebacks?
Yes, sale leasebacks. You often see these when established companies want to free up capital tied up in their real estate
So the company sells the building.
to an investor, like one of EBG's clients, and then immediately signs a long-term lease to stay in that same building as the tenant.
Okay, so the company gets cash, the investor gets a tenant right away.
Exactly. It can be a win-win. In this specific case, the tenant is a big one. A top 10 U.S. rental company. And the lease, 10-year absolute NNN, secure.
What makes this particular industrial deal institutional grade? Is it just the building?
It's really about the backing. The lease is guaranteed by the parent company, and EBG notes that parent has a $35.5 billion market cap.
Wow, okay. That's serious financial backing.
Huge. It means the lease payment is incredibly secure, almost insulated from local market ups and downs. It basically turns the property into a corporate bond, financially speaking. Certainty of payment is the name of the game there.
And they mentioned another industrial property too, 15,000 square feet. The emphasis there seems to be location again.
Yeah, hard corner, I-20 and Loop 281. And they give us the traffic counts. 36,000 vehicles per day on I-20, 15,000 on the Loop.
Vehicles per day.
Mm.
Just clarifying that metric for listeners. It's all about traffic volume.
Right. And that directly connects the physical spot to how much visibility and access the business tenant gets. High traffic usually means high value for that tenant.
Visibility equals potential customers equals cash flow. Makes sense.
Exactly. Especially for industrial or retail businesses.
Okay, let's climb higher. The $5 million to $10 million bracket. The focus here seems to shift, right, towards more specialized properties and really affluent areas.
Definitely. We're targeting serious wealth here. Look at the 12,094 square foot retail center. It's 100% leased, prime location in the Keller retail corridor.
And the key data point.
Demographics. The average household income within 3 miles is $198,000.
Okay, that's significant.
Yeah, they're not just betting on growth anymore. They're investing where significant spending power already exists and is concentrated.
We also see a couple of sectors in this bracket that are known for being pretty resilient, almost recession-resistant. Childcare and veterinary clinics.
Very sticky sectors, yeah. They aren't really threatened by e-commerce, are they? People need these services in person.
So tell us about the childcare center.
It's a 10,000 square foot facility.
Yeah.
Brand new. Basically a 2023 build to suit.
Meaning purpose-built for the tenant.
Right. It's got 13 years left on the lease. It's a nice 7.5% cap rate. And again, location is crucial. Average household income is over $118,000 within just 1 mile. Affluent families prioritize quality childcare.
Makes sense. But the really heavy hitter in this group seems to be the veterinary portfolio. What makes that so secure in EBG's view?
The security there is stacked. First, they're built to suit Class A facilities, nice buildings.
Sure.
They have long corporate leases, around 11 years remaining. But the real anchor, the operator, it's a massive 840-plus unit operator.
Wow.
And this is key. They're explicitly backed by private equity.
PE backing. What does that signal to an investor?
It signals a huge level of institutional financial stability. It means the landlord is protected from just local issues, even regional downturns.
Yeah.
The commitment is national, backed by serious capital. Very, very secure.
Okay, institutional grade for sure. Now, finally, in this premium $5 and $10 REM range, we also see land deals. That seems like a shift from immediate income. What's the strategy there?
Yeah, this definitely points towards EBG's longer-term view on DFW development. They're not just listing random plots. They're signaling where they believe future density and value will concentrate.
Give us an example.
Well, there's a big 37-acre piece zoned for residential. It's being sold via sealed bid by the school district, CHISD, which often suggests pressure to develop housing.
Okay.
But maybe even more telling is the 6-acre unrestricted land parcel. It's got frontage on U.S. Highway 380, and it's in the McKinney ETJ.
ETJ, extraterritorial jurisdiction. For the investor, what's the significance of being in the ETJ versus inside city limits?
It means it's technically outside the current city limits, but McKinney controls the development standards, and crucially, it's right in the path of expected growth and likely future annexation by the city.
So it's basically next in line for development.
Exactly, and EBG spells it out. They call US 380 frontage DFW's hottest growth path. It's a direct signal. They see that northern corridor exploding. Huge potential appreciation.
We've got one more land piece, right? A mixed-use lot.
Yeah, 2.2 all acres. Potential for, they say, up to 84 apartments plus retail. And they note the city is actively supporting redevelopment along that corridor.
That helps. And the owner financing mentioned.
That's a big tell. Offering owner financing suggests they want to get a deal done now. It lowers the barrier for a developer to jump in quickly. It signals EBG's strong confidence in that specific location and the city's vision for it. They want to accelerate development there.
Okay, super interesting mix of strategies across the board. Before we wrap with takeaways, let's just quickly put the source in context. Who is Eureka Business Group? Why should we pay attention to their focused opinion?
Sure. Well, EBG, they've been around since 2008. They are a full-service commercial real estate brokerage.
But they specialize.
Very much so. Their focus is exclusively on the Dallas-Fort Worth market. And within DFW, they specifically guide retail investors, retail leaders, franchisees, business owners, mostly centered around retail CRE.
So deep expertise in a specific sector in a specific high-growth geography.
Exactly. That's why their commentary and deal selection for DFW retail and related assets carries weight.
Okay, great context. So let's bring it all together. The major takeaways for you, the listener, from really digging into this EBG material, I think there are 3 key things. First, that core tension, right?
Definitely. Be wary of that cap rate compression driven just by seller optimism. Stick to the fundamentals. The deal's actually closing in that 7% to 8% range for proven quality. Don't overpay based on hype.
Second, the anatomy of quality is pretty rigid for them. It's non-negotiable.
Yeah. If it doesn't have that absolute NNN structure, if it lacks a strong corporate guarantee or backing from, major PE or a multi-billion-dollar parent company, EBG seems to pass. Secure, passive income structure is king.
And finally, the actual investments they highlight tell a story about DFW's strategy. It's diverse.
Absolutely. They're doing complex industrial sale leasebacks, capitalizing on those resilient sectors like vet clinics, but also, really importantly, aggressively planting flags with strategic land buys along those key growth corridors like US 380 and Anna and McKinney.
Which really brings us to a final thought, maybe a question for you to consider if you're looking at DFW.
Yeah, it's this. If EBG is simultaneously targeting established wealth, like in Keller, and making these aggressive land plays in booming corridors like McKinney, what does that signal about the optimal strategy moving forward?
Right. How do you balance those two plays?
How should an investor weigh the immediate stabilized income from something like that new built-to-suit childcare center against the potentially explosive but maybe longer-term appreciation of raw land on US 380?
Is guaranteed cash flow now the better bet? Or is it that exponential growth potential later?
That decision, how you balance those, really defines your whole investment approach and risk tolerance in this very dynamic DFW market right now. Something to think about.